A very warm welcome to the Risk Reversal podcast. I am clearly Guy Adami. She is clearly Elizabeth Thomas of SoFi. We're talking on a Monday afternoon. Friday was a fascinating day. So let's start there, Elizabeth. What were your thoughts on, how the market performed or lack thereof?
Friday was a fascinating day for a couple reasons. I think the first and biggest fascination for me was, haven't we learned by now that some of this is just like hocus pocus? The statements, and it'll either get changed or pulled back, or let's not react in the moment because who knows what the next moment holds. So I was honestly surprised that the market reacted so negatively into a weekend where there might have been more developments. However, I think a lot of the negative reaction, the big negative reaction, was because we were coming from a little bit of a fragile place given how extended things were. And there was a lot of steam that was available to come out. So it certainly did come out. And then we all know about algorithmic trading and some of the triggers that hit, which just feeds more and more selling on the downside. So I think that was a big part of what happened on Friday. I think maybe more interestingly, a lot of it did come off the table over the weekend, but more interestingly today, I mean, this is a bounce. This is definitely a bounce to pay attention to, but compared to what happened on Friday, we certainly didn't make it all back.
Fair. So my instincts suggest you're not a fan of the game of poker. Is that true?
I mean, it's not that I'm not a fan, I just don't really know how to play, and I
Fair
don't have
enough.
a good poker face.
No, but there's a well, there are a couple sayings in poker. One of them is within 20 minutes, if you don't know who the sucker at the table is, it's probably you, number one. But what everybody is trying to sort of ascertain is everybody's tells. And I guess my question to you is, was Friday a tell in the market? And you sort of addressed it when you said there was a lot of steam to come out, but did we see glimpses of the fragility of this overall market, the way it's sort of been, what it's been built upon? Because when you see a move of that magnitude, listen, I understand the magnitude of the commentary of the president was not favorable to the market, but was it that unfavorable, I guess? And is this does this show you sort of what we're setting up potentially for?
Yes, and I think more importantly, the assets that got the biggest hit, right? So looking at things like meme stocks and crypto and the really risk on assets that have run up a lot in the last, even just the last 3 to 4 weeks, that's what got hit the most. So I think the fragility there is obvious. A chart that we've shown a number of times, we don't need to see it right now, I can easily explain it, is the return on the S&P and the proportion of it that is due to earnings and the proportion of it that's due to multiple expansion. And that little portion that is due to multiple expansion has continued to grow, which is the most fragile part. And the stocks that are driving that multiple expansion are the ones that are going to get hit hardest at first. So thinking about during a sell-off, what happens? It is, yes, the stuff that's run up the most, but then you also have to look at parts of the portfolio, whether it's active managers or retail traders, looking at if they're trying to sell, if active managers are getting redemption requests, they're selling the most liquid stuff first. So they're selling the biggest one first. They're selling the ones with the bigger gains because that's easier to liquidate. It's a little bit less of a gut punch, right? So then the ones that have produced those gains, which as we all know, some of the largest stocks in the S&P, or let's say the top 10 stocks in the S&P, likely to take it a little bit harder. That's not necessarily what happened on Friday. I think what happened on Friday was the risky stuff first, but if that sell-off had continued, I'm willing to bet that you would see it bite into those larger stocks, the ones that are the most liquid, over the course of the following days.
Yeah, I agree with that. So, with that said, we're starting earnings season, which is amazing. But here we are. We're gonna hear from all. Well, not all. We're gonna hear from a number of the big banks tomorrow, then subsequently on Wednesday. So, walk me through not the importance vis-a-vis the weight in the S&P, because it's not a big weighting at all, but in terms of just the landscape and potentially some of the commentary out of the banks. And then I'd like to ask you about the KRE, but let's start with the big banks first.
Yeah, so the big banks always kick off earnings season, and the tone is more important than the results, I would say. I think that's going to continue to be the case this season. What I think a lot of investors are going to be listening for is capital markets activity comments. So we're listening for guidance out of the banks and if they make any hints at what 2026 might hold. But capital markets activity, there have been more IPOs than earlier in the year. That started to heat back up again. M&A has heated up quite a bit. That all should be positive for the banks. It should be additive, accretive to their bottom line, and maybe their guidance will change on the go forward and what they're expecting for capital markets activity for the rest of the year and into 2026. Listening to that for a couple reasons. First of which, obviously, earnings for the banks and the financial system and its health overall, but also for, is it actually a bubble? Is it something that we need to start being concerned with? Are we going to see IPO activity a la 2021 again? And is that something that we should be worried about now? I don't think that we're anywhere near that. I know we're not from a number of deals perspective, but the size of each deal has gotten much larger. So the size of each deal on average is about the same as that 2021 period, but the number of deals is still far, far below.
Let me ask you a question. Does the favorable yield curve, is that offset by the potential for an economic slowdown? People are pointing to a lot of things. They're pointing to the favorable yield curve, yields coming down. Not entirely true, but I understand what they're looking at. M&A activity, regulation being rolled back to a certain extent. And I'm not asking you to play the valuation game, but I look at it and say all those tailwinds are more than priced in, and I don't think the market is necessarily looking at the headwind that's out there in the form of a slowing economy.
Yeah, I mean, if the economy does slow and we've got real labor market concerns that bleed into recession fears, which is not happening right now, but if that should happen, financials are one of the most cyclical components of the economy, so they would be pressured by that for sure. The favorable yield curve, and what you mean by that is the steepened yield curve, so the spread between short and long-term rates, and as we know, banks lend on the long end and borrow on the short end, so their profit is on the long end and their cost is on the short end. So the bigger the spread there, the bigger their profit, which is when we talk about NIM or net interest margin, that should be favorable to the banks. That is a tailwind, but I don't think that it's having as much of an effect as the commentary it's gotten. And could it offset some of the pressure of a weaker economy? Some, but definitely not all. And the banks have had a pretty big year already. They've been doing well. If there's the expectation for more capital markets activity, and that's what's driving it, which I think that is a good portion of what's been driving bank returns, I think if that starts to slow down, then we have more of a problem, and a favorable yield curve can't offset that entirely.
All right, so square this circle for me to the extent that you can. The KRE, which is the S&P Regional Bank ETF, all basically comprised of Citizens Financial Truist, all like somewhere between 1.5% and 2% of the overall ETF. So it's somewhat equally weighted. Most of the names, a lot of small banks. So with that said, this is an ETF that made its all-time high in January of 2022, somewhere around 80-ish. As we're sitting here today, it's trading around 61.5, 62. So significantly off its prior all-time high, underperforming the S&P, underperforming the larger banks. I guess my question to you comes in the form of this. If the landscape was so favorable for banks, regulation being rolled back, M&A activity, I would have thought that this is an ETF that should be approaching, if not through its all-time highs, yet it's not.
So if M&A activity continues in the financial sector, and it really hasn't happened much. There was the one big deal, was it last week or the week before, which was Comerica, right? And Fifth Third. That was really the only one that's happened in a long time. If that picks up again, I think we'll see that ETF find some more upside. But this is exactly my point about the yield curve. It's not having as much of an effect as it's getting in commentary. If that were such a tailwind, the regional banks would actually be doing much, much
That's right.
better because they do not have as diversified of a revenue stream as the big banks or the diversified financials. They're not really benefiting as much from M&A activity. They're not benefiting as much from deal size. The bigger banks are. They are dependent much more on that net interest margin. So a steepening yield curve probably has helped them, but it hasn't helped them as much as the other bigger banks have been helped by a rollback in regulations. The rollback in regulations, if it starts to cause mergers and combinations with those smaller and regional banks, then sure, the valuation multiples will change at times, right? Usually the acquirer goes down and the acquiree goes up. So you might see some of those deals come in and then they'll be sort of guilty by association on the positive side. That could happen, but this actually just reinforces my point that net interest margin and the steepening yield curve has not been as much of a positive catalyst as many people thought it was.
Yeah, I 100% agree with you, and I think you're right in your assertion. It's just it's funny, not funny, but I think it's worth watching the relative underperformance of this sector, especially as we head into earnings season. Something I'm gonna because to me, this is really a statement about the meat of the economy, like really what's going on. And if these banks continue to underperform, maybe they become some sort of leading indicator. We shall see. With that said, we talked about Friday's action. You saw a big move in the bond market, which I guess makes sense. Flight to quality in the form of bonds, yields go lower. Today, Columbus Day, the bond market is closed, but the TLT is trading. Maybe there's some method to the madness with a statement like that on a Friday out of the administration because they're obviously wanting for yields to go lower. And one of the ways to do it is to sort of say some things that are going to spook the market. And, I'm just throwing that out there. And, I'm not asking you to pontificate about the politics around the bond market, but I think some of it might be going on right before our eyes.
Yeah, I mean, I hope that that wasn't one of the main reasons for an announcement like that was to try to move the bond market because obviously it had the opposite effect in equities, and I think that the administration does look at both of them as their report card. So failing at one and winning at the other, I don't know that that really evens out to much of
Mhm.
a success. So the big moves in the bond market were another thing that actually surprised me on Friday, especially because of what's been happening in the gold market and what's been happening even in crypto that I didn't think there were as many investors that would flock to treasuries as a form of safety. Now, gold was up pretty strongly on Friday. It's up again very strongly today on Monday. And that appetite doesn't seem to be going anywhere anytime soon. I would have expected very strong performance in gold given what's happened from a momentum perspective and what it seems like people are using it for, and maybe less of a reaction in the bond market because however, this is something that I think you and I especially need to think about is all right, maybe the drivers of the bond market aren't exactly what we expected them to have been over the last few months. Yields rising because of a lack of confidence, right? Yields rising because of a lack of confidence in the administration, lack of confidence in monetary policy, so much geopolitical risk, and even ballooning budget deficits that were going to cause problems down the road. And then you've got one risk off day, and everybody still floods back into bonds as if that is the confidence booster. So, still, some of those dynamics are intact. That's a relationship that is intact, apparently, more than I more than I thought it was, frankly. And so we have to see what happens going forward. But that surprised me.
You're right to point out that you had one move in the bond market, which was offset by the equity market. The only sort of caveat I would put on that is, and we used the poker reference earlier, so use it again. When you're the big stack, you can be aggressive with how you play, and I say that because with an S&P 500 at an all-time high, you can sort of play with some chips, hoping that that play might move something else that you need to move or move somebody out of a seat that you need to move. And that goes back to the poker reference. So I think they were, again, this is just me, I think they're sort of willing to play a little fast and loose with the equity market, understanding they have a lot of chips to play with. But in the bond market side of the equation, they're sort of running out of chips. So I just throw that out there just to throw it out. But you mentioned the gold market, which I'm glad you did, because I would have thought incorrectly. If you told me on Thursday the equity market would sell off to the magnitude that it did, and then say, okay, what's going to happen in gold? What we have seen the last few years is when there's a risk off situation, gold is not spared and gold sells off, yet didn't really happen, which
Right.
again, going back to that whole thing about tells, like what is the gold market trying to tell us all? Because it is historic, the moves that we're seeing. And now, oh, by the way, silver is starting to rear its head. It's been doing it for a while. And now people are taking notice of that as well.
Well, and I'll be interested in your take on this because you're the commodities expert, but I'll offer a couple things. So, Tony Pasquarello had a note out over the weekend talking about the move in gold and basically suggesting, and this is something that Mario and I have tracked too, is the decoupling of gold from real rates. Now, I don't want to get too in the weeds on this, but just very simply, what's happened over history is gold has been looked at as a safe haven asset that reacts to movements in real rates. Gold has zero yield. So as rates come down, gold becomes more attractive. As rates have risen, right? If treasury yields are rising, investors should theoretically invest in treasuries because you can get a yield there. So gold comes down. What's been happening lately is you're seeing real yields rising and gold rising. So the relationship is broken, right? Or at least it's changed for whatever reason. And Tony's suggesting that the reasons it's changed are debasement of fiat currency basically around the globe and a rebalancing that central banks are doing. So, and that we've known. Central banks have been the biggest buyers of gold for a while now, and this rebalancing of what they're using as reserves. A lot of that changed in 2022 when Russia invaded Ukraine and the dollar was weaponized. Central banks realized, well, wait a minute, I don't want to not be in control of my own reserves. So instead of holding them in dollars, I'm going to hold it in gold instead, where I am in control, or at least more control. So that's a lot of what's been driving, I think, the move. But what's happening on a day where it's risk off and gold continues to go up? Well, I do think it's still exactly that, right? There's some maybe relationship that day of real yields coming down, which we just talked about. Real yields came down, so then that should make gold more attractive and a safe haven asset. But I think this, again, because it was a geopolitical strike, is less confidence in central banks and maybe more confidence central banks saying to themselves, this is why we should own gold, right? Because we haven't figured this out yet, and things just continue to get more and more dicey. So more buying happening. The last thing I'll say on this is that we know central banks have been doing all the buying. If you look at ETF flows into gold, still way behind where the price has risen on gold itself. So the retail trader is still chasing this gold trade higher. So that's even more demand. And on a day like that, you've probably got retail going in as well.
You coined the phrase relationship problem in terms of all these things that historically work that have not. I mean, you talked about it last week when we had our conversation. You were talking about it in terms of the weakness in the yen juxtaposed with the weakness in their bond market, rates going higher, currency going lower, which historically doesn't make sense. But now we're seeing these relationship problems across a swath of different asset classes, which to me, again, should be concerning. I mean, obviously, it's not concerning the S&P because even with Friday's sell-off, you still have an S&P 500 with an earshot of an all-time high. But at some point, all these relationship problems are trying to tell us something, I guess, is the awkward point that I'm trying to make. And again, I think I know what it is, but it's clearly not manifesting itself in equities yet.
I think the general point would be that we are in an unsustainable position, just full stop, because the relationship problems that we can identify between assets for long periods of history usually find a way back to their normal pattern. So the fact that we're finding more and more of these across asset classes or in commodities or between stocks and bonds is suggestive to me that we're just in an unsustainable position. Now, it can go on for a while, and some of these relationship problems have been going on for a while already. It doesn't mean it has to end tomorrow. This doesn't call a top, it doesn't call a bottom, it doesn't call an inflection point at all, but we probably cannot sustain this forever. It can't stay this way forever. So that's why all of the statements of, well, it's different now because AI. I don't I don't know. Sometimes the explanations are very loose, but right, it's different now. The market doesn't respond to monetary policy the same way, or debt doesn't matter because you insert whatever the argument is that's different now. I don't believe many of them are that different now. Of course, things like AI will change the economy and change the way that companies make money, but does it change the long-held relationships between certain economic indicators or certain asset classes or interactions between rates? No, I don't think it changes that.
We're however many days into this government shutdown. And again, to use the word, what I find remarkable is that, it's seemingly we're not really talking about it. I mean, the news cycle has moved on for a myriad of different reasons. I mean, which I understand, but it's still there. It has not gone away. And, we have a Fed meeting at the end of the month. I think it's Wednesday, the 29th into Thursday, the 30th, if I'm not mistaken. So, that's going to be here before we know it. I have no idea if this thing get solved before then or not. But what I will say is, of all this government data that, we're somewhat reliant upon in terms of trying to forecast markets. Obviously, the Fed is reliant upon it. There are rumors. Well, maybe it's not rumors. I don't know. CPI might be coming out next week. So how does this whole thing work? If the government were to, let's say, reopen sometime next week, does all the data that we missed, does that all get sort of put out in masse, or is it just business as usual and we'll go on with the calendar, as it should be moving forward?
That's a good question. I honestly don't know the answer to that. I don't know if they just let it all come out as it's ready, or maybe at the next scheduled release date, they
Mhm.
release 2 months of data. A couple things that are interesting to point out. In the past, when the government has shut down and data releases have been delayed, it has made the Fed more dovish. So that's something to look for. The Fed meeting that's coming on October 29th, right now there's a 96, 97% probability of a cut still priced into markets. You are correct. They did talk about releasing CPI next week, Friday. That's the date that's been stated so far. It's been declared a necessary piece of information to release, or at least to generate, because Social Security payments depend on it in order to calculate the cost of living and the standard of living adjustments that go into those. So, in order to keep Social Security payments running, we have to have CPI data. So, that will be released next week, Friday, which is before the Fed meeting. So, there will be inflation data for the Fed to operate on in its next meeting. That's something that I think is important, perhaps not the most important, though, because we don't have jobs data. And that's been the thing that the Fed has been queuing off of, and what the market has been queuing off of more so. So if we go into this Fed meeting still with no labor data, the Fed's going to have to be using models that it has created to try to back its way into what the labor data might be. We've seen a couple estimates, right? We've got ADP. We always have the private reports that come out. So we've had ADP, which was not great, and Carlyle Group comes out with something which was not great. I don't know what the Fed's models are going to suggest, but I imagine even just given those two pieces of information, their models can't be that far off, so probably not great, right? And the other thing is, if the market is already pricing in one cut for October, absent new labor data, we're getting one cut, right? They're not going to surprise the market without any data to prove it. So that will probably bake itself in, and maybe there's not much of a market reaction that day at all.
Are you familiar with a gentleman named John Venn who perished in 1923? He was born in 1834. Does that name ring a bell to you?
No, no.
No.
Like a
Well,
Venn diagram? Is
well,
it?
see that? There you go. Yes, he
Oh,
is the John Venn of a Venn diagram, and I mention him because it's not a perfect correlation, but you start and see a lot of things on Twitter, X, whatever it's called now, about all the different overlaps in this whole AI investment cycle. And today, Broadcom has gotten himself into the picture. And I know you and Mario look at this stuff. And again, I'm not asking you to talk about the stocks, but when you see this, we have seen things like this before. And historically, the circular nature of these investments don't end well. But right now, with each announcement we're getting, it's giving another leg to this AI trade. So just thoughts on that in general.
yeah. So Mario and I actually talked about this for a long time today. I think the best diagram that I've seen was done by Bloomberg. It's out there. It was done last week, but these diagrams are all over the place. And yes, they look like Venn diagrams, but then they have a lot of arrows and everything is pointing at itself. So I don't know the answer to this. I stared at the diagram for a good amount of time today and tried to ask myself, okay, if this is a house of cards that we're building, what happens if each card falls out? What if we just independently remove one card, then keep changing which card it is? Which one takes it all down, right? Does one take it all down? And I think we all know this. Most of the arrows point back to or out of NVIDIA. And now OpenAI is another one of those where most of the arrows are connected to that. The deal today really just adds one other bubble on the Venn diagram, right? And that bubble is, I'll call it average size compared to the other bubbles. But it's something that, because it's so interconnected and because the funding depends on basically everybody's success, my concern would be that if the market starts to draw down, and this could happen for any myriad of reasons, it might have nothing to do with AI whatsoever. But if the market starts to draw down and any of those companies don't have as strong of a capital position, then you've got spending problems, right? I don't know really what could take it down aside from a shock or something, some sort of market drawdown that creates a spending problem and then everybody pulls back. Mario suggested that nobody's going to pull back from spending anytime soon. It's going to be really hard to convince these companies to pull back from spending because of the way the market has rewarded spending. So if the market continues to reward spending, then they don't probably pull back for a while. But The market, I think, is the linchpin in all of this, right? If the market turns, or if the market stops rewarding what it's been rewarding, then we've got a circular problem that has a lot of different weak links.
There's a saying in life, in sports, in order to be the best, one needs to beat the best. And in Major League Baseball, the best in the form of last year's World Series champion were the Los Angeles Dodgers, who now find themselves playing the Brewers of Milwaukee in a 7 game set. That, coupled with the fact that your Packers of Green Bay continue to acquit themselves very well in that NFC North, whatever they call it. It used to be the Norris division, but you follow what I'm saying. So,
Correct. Yes.
quickly, just how you feeling about, I mean, give me a vibe check in
Well,
terms of being from the
okay.
state of Wisconsin.
This is hilarious. On my way to work today, I saw, I think, two of each, Brewers and Packers logos on New Yorkers, which that never ever happens. Okay. And these appeared to be people who were like going to work, not tourists. And I think last week you referred to some of them as Johnny come latelys.
Yes,
I
I
think
did.
there have been a lot of Johnny come latelys to the Wisconsin trade right now, and I'm all for it. But come on, guys. I mean, if you weren't in it from the start, I'm happy to have you as applauders in the background, but like, let's be real about your fandom.
No, let's
I think
exactly.
it's
I
been pretty
mean,
cute to watch the
I'm
Wisconsin logos that have suddenly appeared on New York City streets.
I have said since the beginning of the playoffs that on that side of the ledger, the National League side, I'm absolutely rooting for the Brewers for a myriad of different reasons, not least of which your affinity for the franchise, but also the whole Bob Uecker thing, which
Yeah,
is playing out right before our eyes. So
yeah,
and the fact that even the most ardent baseball fan would be hard pressed to name 3 or 4 different people on these Brewers of
yeah,
Milwaukee, not named Kristen Yelich. So
right.
it's a great story, but don't
It's a
pretend
great
that you've
story.
been
Well,
on back of it the whole
if
time.
you can't find any, let me give you a couple more reasons to root for them. The first of which, of the 4 teams that are left in the playoffs, we have the lowest salaries by a long shot.
Mhm.
So this is not a team that pays for its roster, okay? This is like wins are done out of just absolute blood, sweat, and tears, not because we paid for the biggest heavy swingers in the league. Other reasons. We've got one of the youngest rosters in Major League Baseball. So these are like this guy Andrew Vaughn came out of the minors. He was in AAA, I don't know, 14 weeks ago or something. Came out of the minors and has been an absolute clutch hitter. He's homered I don't know how
We
many
we
times in the
say we
playoffs
say
now.
a revelation, that's the term,
Yes.
you could use
Yes.
that.
So the culture has changed him and he is a winner. And then we've got like rookies on the team that are just shining. So there are so many reasons to look at this team and say they are the underdog by all senses, right? Except for the fact that we had the best record in baseball. But we got that best record by working hard and pushing and having a good culture in the clubhouse. I mean, all of those things matter. And I think that's why you root for them, not because you've got the biggest salary in this Final Four, which happens to be the LA Dodgers.
It's a great vibe. It is Samson and what did right? Goliath was what talking about. Davy and Goliath, whatever the hell it is.
Yeah,
But
Dave and Goliath.
David and Goliath. But here we are. I mean, maybe Goliath is in fact the Milwaukee Brewers. Maybe we're all looking at this incorrectly. With that said, looking forward to the work you and Mario do. We'll have it on Market Call this week. She is Elizabeth Thomas. I'm G Swizz, and we'll talk to you soon.